Think about how much the wider world economy affects your day-to-day life. Things like gas prices, loan interest rates, even what you pay for groceries. They're all connected in some way to how strong the US dollar is globally. It's really like foundational for us here.
Absolutely. And it's not just here at home. The dollar is, well, the backbone for a huge amount of international trade and finance. It's the go-to currency for so many deals across borders.
Which leads us right into our deep dive today. We've been looking at some, frankly, quite compelling analyses, asking a pretty big question. Could recent economic policy decisions actually be weakening the US dollar in the long run?
Yes, these sources we looked at, they really reflect a growing unease among financial analysts. They're watching current policies and thinking about what they could mean for the dollar's place in the world.
Exactly. So our goal today is pretty straightforward but important. We want to unpack the arguments for why the dollar might be weakening. And maybe more importantly, figure out what that could actually mean for you, the listener.
Right. Let's start with where the dollar stands now. It holds this special title, the world's reserve currency.
Okay, hold on. Reserve currency. What does that actually mean in practice?
Okay, good question. Imagine, say, a pig farmer in Mexico selling pork to a restaurant over in South Korea. The Korean buyer probably doesn't keep a lot of Mexican pesos handy, right?
Uh-huh.
And the farmer in Mexico doesn't really need South Korean won. So they need a currency they both trust, one that's easy to trade. Usually that's the US dollar. The Korean company swaps one for dollars to pay the farmer. The farmer then swaps those dollars for pesos. Simple as that.
Oh, okay. So the dollar is like this middleman, this universal translator for money, basically.
Yeah.
Got it. And what's the upside for the U.S. in having this status?
Well, it creates this huge constant demand from all over the world for dollars,
Yeah.
and crucially for U.S. debt treasury bonds. This high demand means the U.S. government can borrow money at lower interest rates than it otherwise might. And that benefit, well, it tends to trickle down. It can mean lower borrowing costs for American businesses, for consumers like you, and maybe helps keep prices a bit more stable too.
Lower loan rates, maybe steadier prices. Those sound like pretty solid advantages.
Mm-hmm.
So what's shaking things up now? What's making people nervous?
The sources we've reviewed, they keep pointing back to recent trade policies. That seems to be a major factor. These policies have created a lot of, well, unpredictability, some would say unnecessary friction in global economic ties. And this seems to be chipping away at the confidence global investors and even foreign governments have in the U.S. economy's long-term stability and its political stability, too.
And is that why we're hearing more talk about de-dollarization? This
Yeah.
idea that countries are looking for ways around the dollar?
That's exactly it. Now, look, the dollar is so entrenched, it's not going away overnight, not even close. But these conversations themselves, they show a real shift in attitude globally. And what's really kind of striking, one source mentioned the dollar has actually fallen about 9% since a certain administration started.
9%. Wow.
Yeah, and that's surprising because, standard economic thinking would suggest tariffs, which have been central to policies, should have actually pushed the dollar up.
Okay, that is interesting. Why? Why would tariffs normally be expected to strengthen the dollar?
Okay, so the basic idea behind currency value is how much it's worth relative to others. Demand matters. If people want to buy a country's exports, they need that country's currency. So strong exports generally mean a strong currency.
Right.
The thinking with tariffs was, okay, if Americans buy fewer imported goods because of the tariffs, then there'd be less demand for foreign currencies like the Japanese yen or the euro.
Okay, that makes sense. Less buying of foreign stuff, less need for foreign money.
Exactly. And if demand for those other currencies drops, they get weaker relative to the dollar, which means the dollar gets stronger. That was theory number one.
Theory number two, you mentioned another factor.
Right. The other angle was economic uncertainty. Trade disputes often create uncertainty, right? And usually when investors get nervous globally, they run towards safe assets. U.S. Treasury bonds have always been seen as a top safe haven. So the expectation was more uncertainty means more people buying treasuries. To buy treasuries, you need dollars. So that also should have pushed the dollar's value up.
So less demand for foreign money, more demand for U.S. dollars is a safe bet. Double whammy pushing the dollar up. But that's not what happened.
Seems not. The analysis we're looking at suggests the opposite might be occurring. Instead of money flowing in, There are signs capital might actually be flowing out of the U.S.
Flowing out. What signs are we seeing? What's the evidence?
One big one is the gap, the spread between the yield you get on U.S. government bonds versus German government bonds.
Okay, the return investors get.
Right. U.S. bonds are paying a noticeably higher return, and they're generally seen as just as safe, if not safer, than German bonds. Normally, that higher return for similar safety would suck money into U.S. debt. Big time.
Yeah, you'd think investors would jump on that. Better return, same safety.
Exactly. But despite that yield gap, the data seems to show investors may be shifting funds away from the U.S., perhaps towards Europe. And we've also seen the dollar weaken against the euro. One source mentioned about 5% since a specific point in time. These kinds of things are making analysts start to really question that whole idea of the dollar being untouchable.
So why now? Why does the dollar seem more vulnerable after decades of dominance?
Well, it's important to remember the dollar's top spot since the 70s wasn't based on some global treaty. It just sort of happened, based on the sheer strength and, crucially, the stability of the U.S. economy and its political system.
The size of the U.S. economy was a big part of that confidence.
Absolutely. A huge, diverse economy is just generally seen as more resilient. Plus, the U.S. Treasury market is incredibly deep, meaning you can buy and sell huge amounts without moving the price much, and it's very liquid. Combine that with a historically stable political system, and U.S. debt became the go-to safe asset for the world. That constantly props up dollar demand. But the argument now, from these sources, is that recent policies are casting doubt on all three pillars: long-term prosperity, political stability, and even the country's creditworthiness.
So it's not just numbers on a screen, it's about perception. How the U.S. is seen as a reliable partner.
Precisely. The sources call out what one describes as the irrationality of some trade moves, like saying any country with a trade surplus with the U.S. must be cheating. That just doesn't fit with how basic international economics works.
Right. Trade deficits and surpluses happen naturally for lots of reasons.
Exactly. Differences in what countries are good at producing, what their people want to buy.
Like a developing nation selling lots of clothes to a richer one,
Yeah.
but not buying as much back immediately.
Right. Then you have slapping big tariffs on close allies, sometimes without a clear economic reason, like taxing stuff the U.S. doesn't even make much of itself. And then the big tariffs on Chinese goods, messing with supply chains, it all adds up. One expert quoted basically said it shows contempt for the rest of the world. That kind of thing really shakes the trust that underpinned the dollar's role.
It paints a picture of unpredictability, maybe even actions that hurt the U.S. itself long term.
That's the worry. If the U.S. government seems willing to ignore established economic norms or act erratically, it makes investors wonder, what else might happen? Could future administrations undermine the Federal Reserve's independence? Could they even, consider defaulting on debt?
Defaulting, that seems extreme, but you're saying the worry itself is damaging.
The mere fact that such possibilities are even whispered about is significant. It adds to the uncertainty, and that uncertainty is pushing some investors to look for safety elsewhere: Swiss franc, Japanese yen, even gold.
Okay, so confidence is shaky. Let's bring it back home. What does this actually mean for average Americans? This isn't just bankers talking to bankers, is it?
No, definitely not. I mean, okay, sometimes a super strong dollar makes U.S. exports pricey, which isn't always great. But overall, if the dollar were to lose its top spot in a major way, the net effect for most Americans would likely be negative. Quite negative.
How so?
Well, remember, that strong global demand for dollars and U.S. debt. That allows the U.S. government to run big budget deficits without interest rates going through the roof. If that demand weakens significantly, the government has to pay more interest on its debt.
And that means higher taxes for us down the line, or cuts to things like Social Security or Medicare.
That's a real possibility, yes. The government would have to find the money somewhere. Tough choices. And beyond that, a permanently weaker dollar just makes Americans poorer in real terms.
How does that work?
Your income, your savings, they just don't buy as much from the rest of the world. Your purchasing power goes down. Your standard of living erodes.
So my paycheck, my 401k, worth less globally.
Essentially, yes. The U.S. has been in this privileged position of being able to trade paper dollars and bonds for real stuff: cars, electronics, clothes from other countries. That's only possible because everyone wants the paper. If they want it less, we get less real stuff in return.
Wow, okay. That puts the benefits we have now into perspective. But you also mentioned the sources say the dollar's reign isn't ending tomorrow, right?
Right, that's key. We need to keep perspective. While the U.S. dollar index, a measure of its strength, has dipped, It's still actually higher than it was, say, back in early 2021. And maybe more importantly, there's no obvious replacement waiting to take over right now.
What about the euro or the Chinese yuan? Those are huge economic zones.
True, but they have their own issues. The Eurozone has a single currency, the euro, but it doesn't have a single government fully backing it with unified taxing and spending power like the US does. Their bond market is also fragmented across different countries. That makes it less appealing as a single, unified safe haven, especially in a crisis.
Okay. And China. Their economy's massive.
China's yuan has hurdles too. They still have strict controls on money moving in and out of the country, capital controls. A true global reserve currency needs to be freely convertible. Plus, there are ongoing questions about the rule of law, transparency, and their bond market, while growing, is still smaller and less liquid than the U.S. Treasury market. So, not quite ready for prime time as the global safe haven.
So, no immediate heir to the throne. But you mentioned dissatisfaction with the dollar system wasn't exactly new, even before recent policies.
Correct. There was already grumbling, particularly about the U.S. using the dollar's power for things like sanctions. Some countries felt the U.S. was weaponizing the dollar system, forcing them to comply with U.S. foreign policy or risk getting locked out of global finance.
So some countries already wanted an alternative.
Yes, that desire was already there. But these recent trade policies, the uncertainty, they seem to have really poured fuel on that fire, made the search for alternatives seem more urgent for some.
So maybe not a sudden collapse, but more like a gradual chipping away at the dollar's dominance.
That seems to be the more likely scenario and the more immediate concern raised in these analyses. The thinking among some analysts is that we could see the dollar weaken further, especially against the euro and yen in the coming months or years, partly because these tariffs are seen as potentially hurting U.S. growth prospects and spooking investors.
And that weakening dollar would make the hit from tariffs even worse for consumers here.
Exactly. Tariffs make imported goods more expensive. A weaker dollar also makes imported goods more expensive. It's a double hit to purchasing power.
So much for the idea of short-term pain for long-term gain from these policies.
Well, the analysis we've been discussing certainly casts doubt on that. It suggests these policies might actually bring both short-term and potentially longer-term pain for the dollar, and by extension for Americans' finances.
Okay, let's try and wrap this up. The big takeaway seems pretty clear. Recent policy choices are definitely stirring up real concerns about the dollar's long-term strength and stability. And this isn't just abstract economics. It could genuinely affect people's financial well-being right here.
That sums it up well. No, the dollar isn't about to be dethroned overnight. But this weakening trend we're seeing and this growing global appetite for alternatives, those are definitely things worth watching closely.
Absolutely. Which leaves us with a final thought for you, the listener. Given how interconnected everything is globally, if the dollar's role does shift more significantly, what other ripples, what unforeseen consequences might we see? Something to definitely mull over as you think about your own financial picture. Thanks for joining this deep dive today.